Hello, Uncle Jim here. We've had a rough couple of weeks in the markets, and now is probably one of the best times to sell puts, either using the wheel strategy or one of the other really good put strategies. There's a lot of good value companies that have really been beaten down. Today, I want to share with you the criteria I like to use to pick the companies. Such things as the amount of debt, how much dividends they're paying, are they growing their dividends? Some key criteria that I use that really makes finding these companies a lot easier. I'm also going to share with you two of the companies that have worked out really well for me and go into more detail why it's a really good time to be selling put options. So stay tuned. I think you're really going to enjoy what I have for you today. Okay, at the beginning of the videos, I typically like to give a quick market update. We are definitely having some headwinds in the market. We are up today, but we had kind of a rough week this week and last week. And typically October is also not a very good month. I believe we hit our lows last October, and we may have that happen again. You may ask, well, what are these headwinds? Well, the first headwind is this potential government shutdown. If they don't make an agreement this weekend, and they do have a shutdown, I think it will probably impact the market. I don't know how much it'll impact it, but it definitely will impact it. Another headwind is what the Fed announced related to the rates. Not so much that they're going to increase rates, even though they did allude to maybe doing one more increase. The bigger issue was the fact that they originally had been talking about maybe 4 cuts in 24. Now they've cut that back potentially to only 2, and maybe the first one wouldn't happen till midway to late 24. I personally don't think that's going to happen. I wouldn't be surprised if the numbers change again and later this fall, or maybe even in the winter, they find the economy really is slowing a lot more than they realize, and they may change their tune again. It just feels like they wanted to scare the market more than it was really necessary. Now, another issue is what I'm calling, or actually the pundits are calling, de-risking of China. I talked about China last week. This week, it's been in the headlines about the real estate and how the Chinese real estate is really going through a rough spell. I think overall, China's going through a tough time, and it's going to impact, like I said last week, it's going to impact a lot of companies that have a lot of investment in China. And two of the biggest names that have the most investment are Tesla and Apple. And I think both of them could face some, a tough time, especially if they don't have delivery of products. And we may not know that the products are coming, or they may not know that the products are coming until the very last minute and they don't show up. So that's also another headwind. Hopefully, my hope is, and they are planning, this chip agreement that they had and this onshoring. Hopefully there's enough time that things can be rearranged and there's not such a drastic impact from China. We can only hope. But that would take probably 2 to 3 years. And so a lot of it depends on what happens with China over the next 2 years. And then, of course, we have student loans kicking back in, I think in October. So that's definitely going to be headwinds. So this is a lot all at the same time. But keep in mind, we do have an election year next year. There's a lot of potential for us to hit a bottom, I'm thinking, in October, and then maybe go into, a temporary bull market or a full-blown bull market. The other point, I guess, with the cuts in the interest rates not occurring quick enough is I do think a lot of banks and a lot of real estate companies are impacted because of these variable loans that change every couple of years. I think they were betting on the rates coming down another % or 2. And I think that's why the Russell 2000 has been down a bit more, and probably why a lot of the banks have been down. So again, if the Fed changes their consensus, I think, things could change rapidly. So it's important to keep that in mind, especially when you're looking at companies and trying to make a decision in who you want to invest in, maybe why you want to work with IWM, because again, it's near its lows. It's not way up like the SPY. Or you may choose SPY because most of the really big companies don't have the debt issues that the small companies have. They have a lot more control, and a lot of them have set up their debt long term, meaning it's fixed for many, many years. So just a few comments I wanted to make just to kind of keep in mind while we go through these next couple of weeks. I'm hoping the roughest time is the next couple of weeks, not going deeper into November and December. I really don't think that will occur with an election year right on top of us. So now the criteria I like to use to find really good companies is I try to keep it as simple as possible. I like, companies that are dividend paying companies. I'm not just in it just to make income. I want to find good companies that are paying and growing dividends that I can keep in my portfolio. And then, if I buy them today and I keep them 10 years from now and they're growing their dividends every year, that dividend will be twice what it is today. And that's what's happened with me with a lot of the companies I bought 10, 20, 30 years ago. So not just companies paying good dividends or high yields, but companies that are growing their dividends. In addition to that, I want them to be growing their revenue, having a low PE, something that's pretty close to the industry standard. So if the industry standard is 15, I would be looking at companies that are around that PE. And then finally, debt. I also, and especially during these times with these higher interest rates, we haven't seen interest rates like this since early 2000s. I got out of college and high school in the 80s, and so I remember really high rates. But a lot of people don't realize it, and we've gotten used to such low rates. And it had a major impact on a lot of retirees. I remember, my parents retiring in the early 2000s, like 2004, 2005, and remembering them complaining about how they can't get any interest to help them during retirement years. So that's changed. At least you can earn a lot better income, on treasury bills or, pretty safe instruments. So, and I'm going to share that at the very end of the video. I'm going to go through the criteria. I'm going to show you in Schwab and probably also Seeking Alpha, what it looks like and how I look at 3 or 4 things. And I do primarily fundamental analysis. I will do a little bit of technical, but I prefer fundamental. I want to own these companies long term, and I want to see them grow long term. Now, have I made mistakes? Yes, I have, and that's also why I've learned that debt is so critical, especially during this time when I've looked at the companies that haven't done well. One, they had too much debt, and then two, they either cut or eliminated their dividend. In the instance of Lumen, the debt, they couldn't cover their debt, so they had to eliminate the dividend. But when you completely eliminate a dividend, it typically doesn't come back, and Lumen has just gone down, down, and down. And the same thing with Big Lots, which is BIG. It also has just been hammered, and I don't think it had enough cash to cover its debt, so it cut its dividend and eliminated it. The other thing I missed with them was the fact that their stores had lots and lots of excess inventory, primarily related to COVID and the after effects of COVID. So again, I'll go over a lot of this criteria at the end of the next part of the video. Now, what I like to do too is once I find those companies, then I have to pick a price I like. Now, I prefer a price closer to a 52-week low. Some companies you just can't find that because they're performing so well that they may be, midway between the high and the low. But again, if you're selling puts, you can potentially get them or pick them up or pick up the put itself or sell the put itself at a strike price that's closer to what I want or closer to that 52-week low. And then I typically like what I call a 15 delta with puts, and it's not exactly 15 delta. It's like anywhere from 15 up to 20 delta. So and typically for puts, it's a negative. So it might be negative 0.15, which is a 15 delta for a put, which is like an 85% probability that it'll expire out of the money, or a 15% probability that it will be in the money during expiration, which would cause it to be assigned to you. So by using these deltas and picking certain strike prices, you can protect yourself in a lot of ways. Also, the shorter you go duration, typically the higher the price. Let me try to explain that a little better. So if you're looking at, let's say it's a $60 stock like Coca-Cola, and it's Coca-Cola, I think, is actually closer to 55 currently. But let's just say it's $60. Now, if you did like a weekly expiration, you might have to pick a price of 58. Now, if you went out a month, well, maybe you could do right around a 56 or 57. You go out 2 months, you could potentially do a like a 55 or even lower. So the farther you go out with the expiration, sticking to the same delta of a 15 delta, you can get a lower price. So what I like to do is I'll go a little farther out to pick a strike that I like that may be closer to that 52-week low, and that's worked out well for me. Now, the exception to the rule is if, and kind of what we're going through now, if the market's really been beaten down and there's some really good names out there that are inexpensive, currently pretty near their 52-week low, you can pick a different strategy, which I call the wheel strategy. Not me personally, but that's what it's called, the wheel strategy. So you sell a put closer to the money because, again, it's at a great price and you really want to pick it up. So you would pick up more premium. And then once it's assigned to you, you can then, once you own those shares, you can sell what's called a covered call. It's covered because you own those shares. And in a lot of cases, if you're doing the true wheel, you're again taking a little bit more risk because you want it to be called away from you. So you again pick up that cash. And then you repeat the whole process. You then sell another put, at a higher strike, not a higher strike, a higher delta. It gets assigned to you, and so on and so on. That's the spinning of the wheel. I do it a little bit different, mainly because if it's at a good price and I really want to own it and keep it forever, I typically will sell the put, and usually it's a cash secured put, but I'll still do vertical put credit spreads at times. Pick up that stock and then sell covered calls, but I will pick a pretty low delta for the covered calls, usually around a 20 delta, because I don't want it to be called away from me. Now, if it's a higher risk company like an Apple or Google or a Tesla, I probably would pick an even lower delta, meaning a higher strike price. Mainly, again, because I don't want it to be called away. I want to continually be able to sell covered calls. Now, I just mentioned that I might do a cash secured put or a vertical put credit spread. Now, the only difference, I typically always start with a cash secured put. So again, let's use Coca-Cola, $60. I sell a put that's expiring in 2 months. I pick up $100 on this one contract that's 400 shares. Now, while I'm in there and I see, well, there's a $50 strike for a put that I can purchase and it's only $8, well, to me, that's pretty cheap. I'll go ahead and buy that put and so turn it into a vertical put credit spread. And that's typically what I started with. I find now that I'm doing mostly vertical put credit spreads, that's worked out quite well. And most of my vertical put credit spreads that I am selling, I have plenty of cash to cover them. So they're almost like a covered vertical put credit spread versus just, a vertical put credit spread where you don't have enough cash and you definitely have to sell it because you can't afford the stock. So I just wanted to add that because I think a lot of people get confused when they see I do primarily vertical put credit spreads. Probably for every one cash secured put, I probably do 10 vertical put credit spreads. It may be a little less than that, but typically that's the case. And again, my goal isn't so much just to make income. I want to own these companies. I want to get that dividend and see it grow because my goals aren't just income from selling the options, but also the dividends. I want to bring in more and more dividends. I had shared in previous videos that my goal by the end of this year was to be earning right around $2,000 a month in dividends. And I'm really close to that. I think I'm within maybe $100 on a monthly basis. I'm right around just shy of $1,900 on a monthly basis. So I'm definitely during this time looking to pick up a few more good companies that have good dividends, that are growing those dividends, that have low debt, that are well managed. So just wanted to share that, kind of go over it a little bit at a high level. Next, we'll jump in and I'll actually share two companies firsthand. These are Williams Sonoma, who actually just had really good earnings and shot through the roof during this crazy rough time in the market. And the other is Qualcomm, which is also a good company, and it's a pretty good price. It's pretty near my strike price. So I've been able to roll it. I own neither of these companies mainly because the vertical put credit spreads have worked out so well. I've not picked them up yet. So, but I'm really close with Qualcomm, and I might want to take a little more risk with Williams Sonoma so I can pick it up. So just wanted to add that before I jump into the next part of the video. And I also wanted to mention, please subscribe, hit that like button. If you're curious about my memberships, take a look below. I'll have details on how to access that. I'm an affiliate with Seeking Alpha. There's a link below if you're curious and want to try Seeking Alpha. They do have some kind of a deal going on. It's, again, in the description. And I encourage you to take a look. I've had a lot of people joining the memberships, the two different tiers. I've got a real basic tier that's $10. You get my trades, you get my spreadsheets, I do special content. One of the special contents that I'm doing currently is I'm looking at moving my 401k into an IRA, and I'll start selling options on it as well. And I'm debating, do I keep it at Fidelity or do I take it to Schwab? I'm pretty much made a decision. I'm going to keep it at Fidelity, and I've opened up a new IRA. So I'm going to kind of compare and contrast the difference, and that will be available to my members. At some point, I will release a video on the channel about it too, but just wanted to mention that. So let's go ahead and jump into the next part of the video, and we'll go into a little more detail about Williams Sonoma and Qualcomm. Okay, now I've opened Schwab, and this is the research page. I'm currently showing you Williams Sonoma, and I wanted to just share with you the kind of quick criteria I like to look at. Here I like to typically see for the 52-week range to be at maybe in the middle or closer to the small end. Now they had earnings that shot through the roof, so they were closer to the middle up until literally a couple days ago. They're down almost $3 today, but they were up significantly. So that's the first thing. I like to get something that's not overpriced, but you can see how it's jumped up. So it was kind of in the middle. But Williams Sonoma is such a good company that it's hard to pick it up at a 52-week low. Here you can see Schwab's rating is A. All the ratings are really high. Now some do have hold. But it's just overall a really good company. Here you can see the dividends, and you can see they increased. What I like about Schwab is I can come in here and I can see, look, they've been increasing dividends quite nicely. Now, if I go back and I look at 2013, they paid $1.16 in dividends. This year, they're looking to probably be closer to, what is it, 350, something like that, 345. Last year they were 305, 242, 197, 187. So they've slowed down their increase, but they're still increasing really quick. The other thing I like to look at is this dividend coverage ratio, 428%. So they've got plenty of coverage. They have plenty of cash to cover their dividend is what that means. And their payout ratio is just the same thing reversed. It's just saying they're just spending 23% of their income on dividends. So they have plenty of room to grow those dividends, and they're not putting their company at risk by paying the dividends. Now you can see here they've had really good earnings. They've beaten earnings every quarter this year, and I like to see that. Price to earnings is low, between 10 and 11%. The forward PE is 11. I believe for retail, it's something like 14% or 14. So it's definitely below what the industry basic is. So they're doing quite well. Again, they've got a high rating. Net profit margin is good. It's one of the highest compared to their competitors. I do like this section for Schwab. It shows you some other potential opportunities. So a lot of times I'll find other ideas to to look at. Like Dix is someone else I probably would want to look at. And this is the big deal. If you look at their debt, no debt, zero debt. They paid off $300 million back in 2021, but they have no debt, which they're paying a good dividend. They're growing that dividend, and they have no debt. It's very unheard of. Very few companies you can find that have this. They've done so well, or I've done so well with selling puts, that I probably need to take more risk, because I've been selling puts on them, I think, for almost a year, and I currently do not own them, and they're one of my best performers. Let's switch. Somehow I got on the wrong one. Here is Seeking Alpha. I also like it. You can see ratings, financials, earnings. I like how they represent the earnings, so you can see they're going to be doing really well in fourth quarter, but not significant. But they typically beat them. So if you come down here, you can see they typically do, and they do adjustments, then they also beat. So some of those, I don't know, the info is showing a little different, but you can do dividends, valuation. You've actually got options to the left. So a lot of good information here. What I really like about them is the summary information and the articles that people write. So the SA analysts say buy, and then Wall Street's a hold, which to me is kind of surprising. What a good company. Why would they say hold? I don't always agree with Wall Street. Quant says strong buy. I mean, hard to find a number that high. And then you can see articles that have been written about them. And I like to read these too, especially if they have a lot of comments. Because a lot of times the comments are real interesting too. Now let's go back over to Charles Schwab. And actually, before we do that, let's come over here. So here's Williams-Sonoma. It's currently 154. And this is what I typically do. I'll bring up this is the option chain. I'll switch it to Greek. So you were seeing Greeks here. You've got delta, gamma, theta. You got all the different Greeks. Now, Schwab does it a little bit different. Instead of having it all on the same list, you have to actually select the drop down and change it. But this is what I like to look at. So here you can see this is a 22 delta. Here's a 16 delta. So just the fact that it's so close to the 15 delta, this is the one I would probably look at. So 135, it's currently 154. This is an expiration for November 17th, so 50 days. Could pick up close to $100 for a $10 spread, and close to $50 for a $5 spread. So at 135, how much risk are you taking? I'm still nowhere near the low. And 135, it was literally at 135 recently. So I would probably go a little farther out, and here you'll see what I mean. So up here, we were looking at a 15 delta at right around 135, I believe. A 16 delta at 135. Now, if I want to do something similar, a 17 delta at 130, so $5 cheaper, I could actually do nearly a 14 delta at 265, 125, and here again $50 difference, and close to $100. This isn't quite $50, but 125. I'm definitely closer to the 109. And that's typically what I do. I'll go a little farther out, and rarely do I hold these for the full 3 to 4 months. In this case, I think if I did this one, it's 113 days, so it's between 3 and 4 months, and rarely do I keep it for the whole time. So I probably would roll it 3 to 4 weeks before that, which seems to work out really well. So, and that's what I typically do. I would come over here, I would select the two I want to deal with, and I would actually run the trade. I have done other videos. If you want to see some of the trades firsthand, you can look at some of those other videos. But this, I just wanted to show you the criteria. So that was Williams-Sonoma. Let's change the Qualcomm. And this, their semiconductor. They're using a lot of the phones. And I think other devices, but they've typically been a good company. So here they're rated a B. They're closer. 101 is their 52-week low. They're currently 110, so they definitely are in that range. They're definitely closer to that 52-week range. Now you might say, well, but why not go higher? Mainly because I've found that in a lot of cases when I'm too close to this 52-week high or I'm in this range up here, I typically will get into trouble with the particular trade or position. So I just found as close as I can get to that 52-week low, it seems to work out well for me. And here you can see my trade that I've been doing for a long time is right at 110, which if you look at this 111, it's right here. So it's been kind of midstream for it. So it seems to come into the money and then come out, in the money, out. And it's been like this. And I've been trading on it for quite a while too. So here we can let's look at dividends again, 2.93, not the highest yield, similar to Williams Sonoma, which was 2.5. But you can see it recently increased dividends. So here again, I'll open it up. I mean, nice trajectory upwards. And then I'll come over here, 244 coverage, so plenty of cash. Not as good as Williams Sonoma, but still quite a bit of cash and a 40.95 payout ratio. And again, if you do the test, 139 back in 2013, you're getting pretty close to $3, it looks like, or a little bit over $3 with, I guess, another dividend payment of, it looks like 80 cents, a little bit over $3. So you can see if you bought it back in 2013 at and had $1.30 in dividends, now you're sitting on $3 in dividends. And that's what Warren Buffett talks a lot about. He talks about his Coca-Cola investment that he did I believe it was in the late 80s, and I can't remember exactly what he paid, but his dividends alone almost match on a yearly basis what he paid for his original investment. So with time and with a company growing dividends, it can do really well. So not as good as Williams Sonoma, but quite good. Earnings, they've beat every time this year. They have been trending down a little bit, and some of that I think has to do with what's going on with China and with the chip industry. I do think they're one of the better companies to invest in. Again, the PE is not through the roof. I think the standard for the industry is higher than, it may be over 20, 21, and so they're a lot lower, 13 PE for the forward PE, and then 14 currently. Now debt, most chip companies do have more debt, so that I'm pretty sure they have quite a bit of debt. So 16 or 15 billion with equity of 18. So I'd rather this be lower, but I think on industry average, they all have lots of debt, and this is more on the low end. I'd prefer this to be more like 50% of what the equity is, so closer to 9, but they are decreasing it. So they went from 15,745 to 15,482, and again reduced it between 20 and 21, and same thing. So they are definitely reducing it. My guess is I believe they're also buying back shares, which also can be really good for investors. And again, you can look, again, really good companies, Applied Materials, Intel, Texas Instruments, Advanced Micro Devices, so all good companies here too that you can look at, and it's easy to compare them. And now if we run over here to Qualcomm and take a quick glance here, buy for SA analysts, buy for Wall Street, and some good articles like this. Like if we look at one of these, they typically go into some good detail, talking about how Apple uses their chip. Now they're talking Made in China 225 campaign. So I think all these companies are planning ahead for dealing with the situation with China. So, and then let's actually look at options trading. So here they're 111. They're pretty close to their 52-week low. Definitely a lot closer to it than their high. And now again, this is set up For Greeks, here's the drop down for 78 days. Here's the delta, 15 delta, almost exactly right here. So you're talking 168 to 170. So I could do this as a cash secured put, but if in this case, I'd still pick up $100, which is what I shoot at. But if I really want to own them, I might not have to spend this kind of money. But if I can get $100 a contract, then I will. But it's a 15 delta is right at 95. You're talking 110. So a pretty good strike price. This is one of the companies I was talking about leading into this video I feel like has been beaten down a little bit too much. So here, if I go a little farther out, it doesn't change much, but the premium does go up. But here's a 12, so I could go down, drop it to 90, and do a 90, 80 for almost $100, a little less. Or if I took more risk, I could again do the 95, but I could bring in almost $1.30, almost, what is that, 80, 70 cents? So I could actually do a 95.90 and bring in, what is that, 42 plus 34, so what, 76? So that's not bad too. But you can see, typically you would be lower, but this is a 17 delta, this is a 12 delta. And then up here you've got a 15 delta is 95. You don't have a 12 delta, this is a 10 delta. And that's why I like to go a little farther out. The closer you get, the more you're going to have to be in this range if you're doing like a 30 or 60 day. So, and again, I would then select it and make the trade. And I typically do market trades. Every once in a while, I will do a limit trade. I think it worked for me earlier this week. I like to do market trades because I like to make the trade and get off. I maybe are losing a couple bucks here and there, but to me, it's important to, be able to make the trade quickly and be done with it and make this as passive as possible. So that's it. That's what I wanted to show you. These are the primary criteria, the things I like to look at. And it's worked out really well for me, especially for these two stocks. I don't own either one of them, and I've done quite well with selling my I think for both of these, I've done vertical put credit spreads. So just wanted to share that. And as always, please leave a comment. I try to answer all my comments. And just thanks for joining me, and I look forward to seeing you the next time.